Welcome to the Property Couch, where each week you get to listen to two of Australia's leading property experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, and Ben Kingsley, Chair of Property Investment Professionals of Australia, and the 2014 and 2015 Property Investment Advisor of the Year.
All right, folks, you're on the Property Couch, where each week Ben and I bring you the insider's guide to property, finance, and money management. Hello, mate.
It's a change.
Welcome to the couch.
Iris, what are you doing?
Iris,
Come on,
seriously.
I'm what type of...
We can't get you to talk, but you'll drop your stuff in the middle of the intro.
That's the intro. Yeah, we've heard her voice too.
No, we're going to keep going. No,
we're
we're going to keep going, Ben. So, by the way, yeah. But anyway, mate, I just figured, we are helping people with property, finance, and money management.
Yeah,
Why not
absolutely.
declare it?
I think so too. That's good. And yeah, I mean, people are using our information not only for property investment, but they're also using it to buy property.
They are.
So,
and,
all-rounded.
mate, I went through all the questions yesterday. I spent a bit of time here in the studio.
Oh, did you?
And there's
bit of prep.
There's a bit of prep.
Gee, I'm glad one of us is doing it.
But there are a lot of people that are implementing money smarts, and all the better for it. So,
fantastic.
Which is terrific news. Couple of things, Ben.
Yes.
Our latest realestate.com.au collaboration is out this week.
Fantastic.
If you want to see what Ben looks like in a yellow hard hat with a pink collar, it's important.
And pink nose.
Well,
and
no,
pink
you
lips.
didn't have a pink nose. That was that was later on in the afternoon. Do you remember where
it was
it
4
came up
degrees,
from 3 degrees to 7,
and it was wind chill factor was still 3 degrees.
Yeah, like the app says, it felt like 1.9. So go and check that out. Ibis will have that everywhere, won't you, Ibis?
Oh,
just
there you go.
pause for effect. Just see if we get there.
She's not going to answer us as usual.
And seeing as we've got a special guest today, Ben, who loves the numbers, I thought I'd actually bring a few numbers up myself.
Oh, okay.
Special number, 2,083,129.
Whoa. What's that?
That is the number of downloads of this podcast.
There we go.
Which very special thanks to our podcast community.
Thank you for listening.
For being loyal and supporting us. That's
Hopefully
terrific.
you get value out of what we're talking about.
Remember how excited we were when we got over the 10,000 download mark? Now we just, 2 million, move on.
No, we're not. That's not move on. We're very, very,
very, you said it well, Ben.
Yeah,
humbled. Yeah. So 2 million, thank you folks for listening to us. And location score, Ben, it's gone very, very well.
Yes, it has. Yeah,
there's an appetite for it.
Yeah, well, naturally, it's really easy to use, and it gives some amazing insights of where you buy your properties. So that's really good. We had a little technical glitch with the security token, but that's as property as IT people, we make good property investors. I think that's what we're sort of. That's all done. So it's all very secure. It's very safe. It was always that way, but there was one token that some of our techies missed. Mm-hmm. So we've got it all sorted out. But anyway.
Very good. So if you want to check that out with the discount code TPC20,
20% discount.
We're going to let the location score out to the masses.
Yes, we are.
But right now it's just within the podcast community, so they can enjoy that if they want to go and check it out.
Beautiful.
Locationscore.com.au. Mindset Minute theme. Today's a shout out to our friends, Ben, who are going through financial struggles of some sort. And we do get people reach out to us saying that they'd love to invest in property, but there's some stuff going on for them. So, but today it applies to any sort of struggles, whether it be marital, career, personal, whatever it is. But for those of our friends who are listening who have got a few financial struggles they're going through, I just want to encourage them today. Difficulties help shape our character, Ben.
Mm-hmm.
Much of our learning could not happen without pain. So if our life is constantly mountaintops, then how are we going to know how we'll respond when we're in the valley? Endurance helps us develop some strength in character, and there's lots of benefits to difficult circumstances, Ibis, but you're not just in a storm, you're in a transition. This too shall pass. Every process has an expiry date, and after every storm there's a rainbow. That makes good Katy Perry lyrics, don't you think?
Is that what the song goes like, does it?
But your current situation is not your final destination. So I just want to shout out to those people that today's Mindset Minute is your current situation is not your final destination. You will get through it. And what I will say to people is if you are in that situation, check out our Money Smarts. It's free. That'll help you get out of those situations so that you can get yourself in a position where you will get out of that. So today, your current situation is not your final destination, Ben. Difficulties help shape our character.
Mate, loved it. Beautiful.
All right, so before I just want to say, Ben, just a quick one to you. What is 2 plus 2?
4.
Oh, I like the way you answer. If an engineer was asked that question, he'd say it lies between 3.98 and 4.02. If a mathematician was to answer it, it'd be in 2 hours I can demonstrate it equals 4 with the following proof. A physicist would say that it's in the magnitude of 1 by 10 to the power of 1. A logician would say this problem is solvable. The social worker, I don't know the answer, but I'm glad we discussed this important question. The attorney, in the case of Smith versus State, 2 plus 2 was declared to be 4.
Oh.
The trader, are you buying or selling? And here's the point. The accountant, what would you like it to be? And with that, we introduce Frank Azzopardi.
Where do we get that bit of gold from?
Mate, I've got to prep for this. You know, I've been waiting all night for that intro for Frank. But welcome back to the couch, Frank Azzopardi from YK Partners.
Thanks for having me.
How are you, mate? We haven't seen you. We're at episode 126. We haven't seen you since episode 48.
Yes.
Where have you been?
Have you missed us?
Waiting for the invite.
We've had loads of tax-related questions which we cannot answer, Ben, but just a reminder for our listeners that back in episode 48 we covered investing in companies, trusts and partnerships. We did the CGT, capital gains tax, and the 6-year rule, and we talked about whether or not BA fees were deductible. So yeah, welcome back to the couch.
Thank you for having me back.
Oh mate, so it's been a busy time for you. How's the end of financial year rush went for you?
I'm not seeing the family much at the moment, so that's okay. It's just that time of year. Silly
But
season.
usually, isn't it true that your run up to 30 June is very busy because obviously people are doing tax planning?
It's end of the earth.
Yeah, and then there's a 2-week hiatus there where you're just waiting for people to get their group certificates and getting all of their numbers rolled over.
Yeah, but with the advent of the new systems that are in place with zeros and all that kind of stuff, the time lag now is so much smaller.
Of course.
So there's no gap really. It's just constantly on.
So if you're not familiar with the terminology of zero is basically a bit of a disruptor. Well, you know, it's a tax package, but it's an online cloud-based tax program.
Yep.
Bit like Quicken have their products and MYOB has an online. So these are just new, basically software packages that allow people to get their
payment summaries are issued
information
before the end of June.
Yeah,
in some instances.
Wow, that's phenomenal. So there you go. So we're nice and busy. Great. Well, good to see you busy.
Yeah.
Mate, how many clients do business clients do adopt zero now versus the old MYOB?
Oh, it's a high percentage, I would expect. And most of the clients we look after are on zero now. There's still a fair few on other programs like MyOB and Quicken, but a lot of them are on zero.
But
it's
has
just
MYOB come out with a later, like a cloud version? Aren't
they do have
their game a bit.
They've got a competitor, but it's not as slick as zero.
Oh, now there were no recommendations here.
And no cash for comment here.
No cash for comment.
Should be my life hack.
We're not on the zero payroll.
Needless to say, I just switched over to them. So
there we go.
But still no affiliate there. But hey, a quick one here, Ben. Sharon Lee wrote in and said, "Hi guys, can you please explain the difference between buying in different entities? For example, I'm buying my first property and wanting to build a portfolio. I'm not sure if I should buy properties in my own name in a trust or in a company name. Thanks for your help." So just a quick shout out to Sharon that was covered in episode 48. Mm-hmm. So you can rewind to that one if you haven't had a chance to look at that. And check that out. But should we go straight into it?
Sure.
Yeah. Expats, mate. We're going straight to the expats. We got a lot of people who listen to us all around the world. So here's one for you. First of all, I'm loving the podcast. This is from Andrea. I listen to them over and over. Hopefully it's not my wife writing in, Ben. Well, actually,
you also listen, don't you?
Hang on a sec. Oh, no, it's not her. I listen to them over and over. It's definitely not my wife. As an Australian expat living overseas long term but preferring to invest my money back home in Australia, are you able to do a podcast directed at Aussie expats wanting to invest back home but are not sure how to go about it? If you could talk about things Aussie expats need to be aware of, i.e. the different rules that apply regarding capital gains, depreciation tax credits, services expats can employ to assist with the fact that you can't make a trip every week to attend viewings, sign papers, etc. Having bought 4 places in the last 4 years, I have not completed my PIPA course yet, and I'm nervous about giving too much advice. Thanks for your help. Frank, expats.
Okay. Expats. So obviously the biggest thing to bear in mind there is the non-resident issue. Obviously once we're not living in the country for tax purposes, we're deemed to be a non-resident. And the rules around that essentially have a non-resident, any Australian sourced income is assessable here and needs to be brought to account on a tax return in Australia. And there are different tax rates that apply to non-residents. You don't get things like the tax-free threshold, which is currently sitting at $18,200, and you just get taxed at a flat rate, 32.5 percent.
So for clarity, if someone is living overseas and earning dollars overseas, they have the non-residents. What if they're living...
So they don't declare that income over here, but if they bought a rental property here, then they have to declare that on a tax return here.
Yeah. So I guess it's always interesting for people to understand if they are accumulating tax credits, that's effectively like money in the bank if they plan to come back at some stage, isn't it? Because
or losses, you know.
Tax
losses.
So in other words, if you've got a negative geared property here,
declaring a loss, so that can carry forward and build up some credits.
Absolutely. So even when you came back, you'd be able to offset those losses at that point in time when you came back and started earning assessable income here.
So what's the takeaway from that is before you're going overseas to work, you should sit down with an Australian tax agent, an accountant preferably, to get some structural advice. Because obviously, depending on your work environment overseas, you could be on a contract, you could be working longer term, and so that's when you make the determination, isn't it, whether you are a resident permanently departed for tax purposes. Is there any examples where you wouldn't declare that? Like, can you think of any examples where it might be a short term? Like, you know,
there are specific rules around whether you're deemed to be a non-resident. Essentially,
so it's case by case?
Case by case, and it's a question of fact, really, what the tax office comes back to.
And what about if I'm an Australian person, say, working for, say, Peregrine, and I'm taking a tour of people away, and I'm getting paid in Australia? That's not relevant, isn't it? So even if I'm spending 3 months on taking these people to trek the Pyrenees, it's completely irrelevant. I'm still getting paid in Australia. So my tax purposes is all accessible here. So it's only the other one where they're permanently departed and they've declared that for the year. Now talk to us also about the tax treaties that we have in place with certain countries, because I think it's important for them to understand. In some cases, if we don't have a tax treaty with them, some of that income could be accessible here. Can you explain that to us?
Yeah, so if there are double tax agreements in place.
Double tax agreements,
between a whole raft of countries across the world.
That
essentially mean that if you're taxed if you're a non-resident.
So let's use an example like in America. If I go and work in America and I earn income in America and I pay my tax on that income in America, does that mean I have to pay that income tax in Australia as well?
No, not if you're a non-resident.
Perfect. So that means that I've paid that. So that's that double tax that we're talking about there. Whereas if the tax has been allocated over there, similar, I suppose, if I'm buying shares in an American company. And let's say that American company, now usually in the shares in American companies, they don't pay dividends, but let's say that they did pay a dividend or a distribution. I get taxed on it over there in the US.
It's brought to account in your tax return here, and you can claim that credit for a foreign tax credit over here, and it's offset against your taxable income.
So effectively what we're saying is that you don't pay tax on it twice.
No.
That's that double tax component.
It's spot on.
It's a tough gig for the expats too, Ben, as you know, because the toughest is for them to try and get some finance, get some cash. You know, you're getting these tax losses carried forward. If you've got the surplus to carry the property, it's not a problem, but it's actually finding the funding for these people to be able to get it. So that's
without having cash behind you. It is tricky.
Very good. Now, Ben, we didn't talk about the obligatory disclaimer.
Yes. Where this is general information.
This is the bit where everyone glazes over and they go, oh, here it comes. But
look, I mean, we're not giving specific advice. The reason why, the same sort of thing, people might ask, well, should I set up a company here in Australia, or should I set up a company with the work that I'm doing offshore? The answer to that is case by case, isn't it? I mean, this is all about understanding your short and longer term objectives. No different than when you're setting up a business in Australia. You should be looking at whether you want to set up a family trust, a company, a partnership, or a sole trader. Those types of questions are really what's going to be asked by the accountant to determine what the best structure is.
You're right, it's case by case, and that's why we like to sit down with clients and understand their whole background and what their plans are for the future and what they've got going on, so we can give them a holistic view.
It's pretty simple. Don't act on this podcast. Go and talk to someone specifically about your circumstances. This one's from Salim. I hope I got that right. Hi guys, I listen to your podcast regularly and learning a lot. It's great. Well, I have a question, searching the answer for a while, but no luck so far. I asked same questions to a few accountants, but all of them have a different opinion. I bought an investment property last year in Melbourne in July 2016. That time I was living and working in Sydney, but very soon in August 2016, I moved to Melbourne in my investment property and living in it as a principal residence. Now the questions are: 1, I paid around $7,500 as lender's mortgage insurance. Can I claim this for a tax deduction? 2, my home loan is still on investment until 7th of February 2017. Can I offset the interest in my tax? Any help would be greatly appreciated. Look forward to your resonance. Thanks, Salim. There you go. So first one,
the chunk
mortgage
of law,
insurance.
You've got to love their mortgage insurance. The short answer is mortgage insurance is not deductible in the first instance, as in it's not an outright deduction, but we can claim it over a period of 5 years in the same regard as like borrowing costs on purchasing a property. So it's just
generally it's over 6 years, isn't it? Because you get 4 full years and then a prorated first year and a prorated 6 years.
It depends.
So, but isn't the determination, so let's not do direct advice for Salim. What we're talking about here is, let's say I bought an investment property and for 6 months, so let's say I bought it on the 1st of July and it was rented from the 1st of July and I basically moved into that property on the 1st of January.
Yep.
Okay, perfect 6 months. That perfect 6 months, now given I paid lender's mortgage insurance, I would be able to claim 1/2 of the 1/5
of that mortgage insurance.
Is that clear? 1/2 of
look at you
1/5. So there we go. So whereas once I've moved into it, technically
It's not an investment anymore because you're not renting it. You can't rent it off yourself.
Okay.
So therefore, it obviously doesn't get declared on your tax return anymore, and you don't claim the deduction for it. And the same applies to part 2 of that question, and that's in relation to deductibility of interest around, regardless of whether the loan is deemed to be an investment loan or not. If you've moved into it as your principal place of residence, then there's no deduction there for it.
The rule there is that the purpose of the purpose test, isn't it? If you've got a loan that's purpose is for investment, then it's typically deductible.
Yes.
And if it's for a private nature, it's typically undeductible. I mean, if you just apply that, because people often trip themselves up and they talk about what's the security against.
Yeah.
It's not. So what's the purpose of the actual loan that you're taking out, and is there an income producing element?
That's more the point, because you can always go and you can buy a property and it be your principal place of residence, and that's a non-deductible debt. But then you rent it out, and the loan still stays the same. You're not going to go and refinance the loan, but the loan's still the same. You can then start treating it as a deductible loan because there's an income producing element there. So.
And Frank, it only has to be available for rent, doesn't it? It doesn't have to be rented. If you've moved out and you've advertised for rent,
you can prove conclusively that that it is available for rent, and there's someone out there.
And hence the advertising, and the advertising costs are tax deductible as well.
Yep.
Now, and just for Salim and the listeners' benefit, what you've also got to understand is during that 6-month example that I used, you were obviously able to claim half of that 1/5 if you continue to live in it indefinitely. But the capital value, i.e. from the 1st of July to the 31st of December, when it was an investment property, you would also want to get that property valued approximately at that time, because ultimately there would be tax on that appreciation during that period as a capital gain.
Yep.
Whereas from that period onwards, it's your principal place of residence.
Yep.
So all of these people think, it's not fair, I won't be able to claim the LMI. Well, you've also got the full exemption of capital gains tax because it's your principal place of residence. So don't feel hard done by in the fact that if your property is going to double in value over 10 or 12 years or whatever it might be, that you've got that tax free. So just be mindful of that. So yes, everyone feels, I can't get a deduction, but it's like, well, that's because it's your principal home, and guess what? Any growth that you're going to have on that property, if you decide to sell it, is going to be capital gains free.
Hey Frank, it might be a good opportunity here to talk about the difference between a repair and a capital improvement, because that can often trip people up in terms of what's deductible or not if they've got an investment property.
Yep.
Is it true?
Lovely grey area. Yeah.
Is it true that if I've got green walls and I've got scuffs on it and I go and buy some green paint, that's a repair?
Yes.
But I change it to blue paint, that's a capital improvement. Is that
no? I wouldn't go down that path. It would be more. The analogy would be more that you've painted the whole house, as opposed to just painted one room.
Okay.
That's when it's a repair, and you've got to think about it from the tax officer's view. They're trying to work out whether you've improved the property to the point where that's not going to be done again for another few years, so we're going to have to claim it as an ongoing depreciable item.
So if I've got one room that's scuffed to high heaven,
Yep.
and so I go and buy 20 litres of it's the same colour paint and just go throughout the house,
Yep.
you've got to prorata that little bit as a repair and the rest as an improvement, or is
No,
that...
you would just do the whole lot as a capital improvement. You wouldn't pick and choose like
Okay.
that, no.
But one's deductible, one's depreciable, might make a difference.
Oh, absolutely.
But on a like a $64 expense for 10 litres of paint.
After the pennies and the pounds take care of themselves, Kingsley. Come on.
But it's
Come
not.
on.
So another example might be the fence. So one fence is falling over, but the other two fences are relatively new. Or okay, but you want to present the house in the best possible light, so you decide to repair or replace, I should say, all of the fence. Same argument applies.
Well, it does, but if you're going down a whole side of a house,
Yep.
then the tax office would take the view that would be a capital item. If you're replacing a part of that fence line, then you could probably argue that was maintenance.
But even if the whole fence was falling over,
if the whole fence on one side of the house
Yeah.
was falling over, then that would be a capital item.
a capital item, okay, not a repair.
No,
Okay.
If the whole fence is falling over, that's not a repair.
no.
Oh.
It would be an improvement because you're improving the state of that particular fence in its entirety,
Right. Okay.
down one side of the house.
So instead of an immediate 100% write-off, it's just basically
You'd
written off over,
over a couple of
Okay,
years.
so you're
And
still
that's
getting the deduction.
That's exactly right. When
Yeah.
people get a little bit caught up with the fact that I'm not getting immediate deduction, but
Yeah.
you are getting the benefit of that money you've expensed. It's just over a period of a couple of years.
There you go. So you heard it here, clear as mud on the property commercial. No, very clear.
Have you got a fence falling over, Ben? Is that,
No. Well, I've got a fence that needs to be replaced. That's another story.
Yeah, that one takes a bit longer than what we've got time around for. This one's from Nick. Thanks for writing, Nick. Hi, guys. Really enjoy the podcast. You have both helped reshape my approach to property investment, and I'm currently in the process of developing an investment strategy that suits the specific circumstances of my partner and I, rather than rushing into the often scary Sydney market. We're a couple currently renting in Sydney with a combined income of over $220,000 a year, around $80,000 sitting in the bank. No kids at the moment, but probably will within the next 2 years. And we'd like to get our foot in the door of the property market. One challenge we face is a high likelihood of moving overseas for work within the next 5 years. If we buy as owner-occupiers, we'll be looking at 2-bedroom apartments in the medium-priced suburbs of Sydney, right at the limit of our purchasing means. Should we move overseas for work, my understanding is that we won't be able to negatively gear the property, since our income tax will be overseas. It does appear that some other countries have negative gearing policies, although it's not clear whether losses incurred from overseas investments are eligible, and the rules differ from country to country. My feeling is that stretching to buy an apartment in Sydney for ourselves now could force us to sell early if we move overseas, and the repayments are strongly outweighing the rental income. Not a situation we want to be in. If we instead look at rent vesting and aim for a cheaper investment property in a growth location somewhere outside of Sydney, with a path to getting it positively geared in the short term, this seems like a lower risk strategy that still gets us to start on our journey to a property portfolio. I'm hoping the principles you talk about have sunk in a bit, and I'd love to hear if you think I'm on the right track. I think our situation is quite common for a lot of young professionals. What tips can you give from both a tax and property selection point of view to the many Australians working overseas or planning to work overseas who still want to invest in the Australian property market and start building a passive income for their futures? There's probably two parts to that question. Probably should.
I think if we break that down, there's a couple of pieces to that. So do you want to have a go?
Well, yeah.
Well, we use it as an extension of the previous one.
Yeah,
about
that's
expats.
exactly right. So we were just talking about the expat community and how the negative gearing affects them, and this is just a similar question in regard. So the negatively geared properties, the loss will just be quarantined in the tax return and carried forward at a later point in time, essentially.
So there you go, Nick. It doesn't matter about the arrangement overseas. If you've got a property in Australia, as an investment property, you'll lodge an Australian tax return, and then you'll be able to carry forward those losses in Australia.
Correct. And what's really important about that is this is a cash flow impact. And I think that's what Nick was trying to get to. It's all, so obviously if we're in Australia, we will get a negatively geared refund, which is a cash flow impact. So you'll get that money back. So the reason why Nick is then leaning towards going for a yield play is because he's factoring in the fact that those losses will be quarantined. So when you do come back to Australia, or when the property, I mean, some people never come back. So when the property does become positively geared, you'll actually have those tax losses quarantined, which will offset the positively geared nature of the property. So this is all about cash flows, and it still comes down to a case by case. So Nick, if you're going to go overseas and earn more than the very good incomes that you're both going to enjoy here in Australia, the reality is you still might be wanting to buy a better asset in a international city like Sydney than to potentially go and chase yield. Okay, so I want to be very clear about that. If you're a client coming in and seeing me, I would want to know about those future cash flows to make sure you could cover the cash flow impact whilst you're overseas. And if you could, then I'd probably be advocating to buy in a bigger city rather than chasing a yield or a negatively or a higher yielding property in, say, a regional area or a second tier location like a sub-regional, Gold Coast, Sunshine Coast type area. So it's important to understand that, because that's the only difference. I mean, at the end of the day, the asset selection is still going to be really important to you. So that's what you've got to look at. So if you can come to those conclusions that all it is just a quarantined loss, and you're going to get that back either by when you return to Australia and start earning Australian income, or when the property turns positively geared, that's all it is. Makes sense?
Yeah, absolutely. Because typically the tenant and the taxman pay most, if not all, of your bills. Yeah. In this scenario, the tenant is the only one paying the bills, and as Ben said, that creates that big cash flow gap. So we say all the time, cash flows tell the story. Yeah, cash flows will tell the story on these guys. They've got good income. It depends how much they're saving quite well.
We've got some great examples of clients who are expats who. We've got great examples of clients who started here in Australia working in the mining sector, have gone offshore for 5 or 10 years to set themselves up financially. We've bought them several properties here in Australia. We've worked out that there's going to be that shortfall on the cash flow. We've still gone for growth assets as opposed to yield assets or balanced assets. And they've come back and now they're enjoying the fruits of their 10 years offshore, where they've earned, in some cases, tax-free income overseas, and they've come back and done that. Or they've reached out to us as expats and we've set them up to buy properties here, knowing that they've got very, very strong incomes. The biggest challenge for expats at the moment is the finance side. So I think it's probably good to talk about that, in the sense that a lot of Australian lenders are a little bit gun shy of lending to people at the moment. Foreign investors particularly, but Australian expats, they're limiting loan to value ratios, and they're limiting repayments to P&I. Now, you do a lot of searching and find these second and third tier lenders, no name lenders as we like to call them. We don't even know who they are. So they're out there and you can get higher lending, but you're going to pay a premium for that. So there is an opportunity to find those, but it's really important to understand, in terms of what Nick's question is, it's a ripper, and it just highlights the fact that all it is you're just going to not have the advantages of the tax, so the negative gearing refund that you're going to get. And remember, if you do hold a negatively geared property right now, this is a great time to talk about putting in your Part 4. No, it's not Part 4.
There's the old 221D.
The PAYG variation.
Thank you. It's a really good time to put in your PAYG variation, because you can get that. You can estimate roughly the loss that you're going to incur, and you can get that in your pay packet every fortnight or month or however often you're paid. Now that sits in your offset, and it's basically offsetting the interest. So it's a terrific, rather than sort of saying, a lot of people use negative gearing as a forced saving and they get it at the end of the year. Don't do that. Yep. Put your here I go again. Put your PAYG variation in. Yep. I was going to say Part 4.
Mate, it used to be called the 221D. It was easier to say. But that's an often misunderstood part of the Tax Act, isn't it? That, for example, if you were going to get a $5,200 refund at the end of the year, the tax department gives you the opportunity to write to them and say, I predict $5,200. Can you put it in my pay pack? And if I'm paid weekly, they'll actually take $100 a week less. out of their pay packet, so you get it immediately.
It's in the tax manual, so it goes into your pocket.
Yeah, which has an impact
like
on.
Ben said, it's not this forced saving thing that some people prefer just allowing the tax office to have their money for
interest
the
free all year.
Exactly.
What's the dangers if you miss it by a certain percentage?
There's always a possibility of interest and penalties by the ATO, but
reasonable person test.
Yeah, exactly. You know, as long as you've made all due care and effort to try and make sure the estimates are correct, and then it's very unlikely that you get looked at.
So there we have it. So two parts there, Nick. It still applies if you're investing. You will have those losses carried forward, and as Ben said, your cash flows will tell the story. But we've got a client in Kazakhstan.
We do.
Expat.
We do.
You could have said London, New York, but Kazakhstan, and it's not Borat.
No, and go and just on that point, go and have a look where Tim lives, because it's a modern city.
Yeah.
Like, you get these images of Kazakhstan, and you go and have a look at their capital, and it's modern, fancy new apartment buildings.
It's amazing.
And it's, as you are scanning into it, you've got all this brown country, because obviously, Kazakhstan, Afghanistan, all that area, very rocky, not a lot of soil. But then you come into this city and it's just like unbelievable. It's just this magnificent, modern looking city. So
I had to do the same, because obviously I've bought a couple of properties for Tim, so I know him very well. And I've seen Borat, and I've seen Kazakhstan through Borat. And there's a documentary called The Long Way Round with Ewan McGregor and Charlie Boorman, which is brilliant.
On the bikes.
And they didn't drive through the city.
They wanted to show on the roads and how difficult and treacherous.
So I'm with you. I had to go on Google Earth and go, wow.
Yeah, it's
a
I'm trying
thriving
to think
city
of the
here.
name of the city, but
Did you know that?
It's a river.
Yeah, no, I didn't.
Kazakhstan. There you go. Put that on your bucket list for holidays. So, all right, very good. Next one from Simon. Boys, love the book, and now an avid listener to your podcast each week. I have a land tax question for your next Q&A session that no one can seem to give me a clear-cut answer. There's a lot of pressure on this for you, Frank. You've got a lot of ones that people can't get clear-cut answers. My wife and I have a principal place of residence in Newcastle, as well as one current investment property also in Newcastle. Recently, we have just purchased an apartment off the plan, pause for effect, which is not due to be completed until late 2018 at the earliest. Currently, all three properties are in both our names, 50-50 share. My question is regarding New South Wales land tax, which the 2017 threshold is approximately $549,000. Let's just say $550 for ease of rounding off. Thank you for that, Simon. Does this mean that as a couple, we have a combined threshold of 1.1 million, or despite having two people owning these properties, do we still have to come under the $550,000 to avoid land tax as a couple? If the latter is the case, what is the best way to minimise our exposure to paying land tax if we wanted to continue to purchase investment properties in New South Wales? For example, should our next purchases be in separate names? Thanks for your help, Simon. So, Frank, the first part is, do they have separate 550s, or is it one for the couple?
Yeah, so the short answer to the first bit of the question is the threshold it's just per property, not per person.
Yeah.
So the 550k is across the two of them, essentially, to answer that question.
Mm-hmm.
It's one for the couple.
Okay, one for the couple.
So it just depends on how much land holding they have in their name in each state. So if they own in their own name individually, and then they own as a couple, the couple gets merged with their individuals.
Spot on, exactly. Mm-hmm. So it's just you have one limit.
Mm-hmm.
Essentially.
Okay.
So let's sort of, I can unpack that a little bit more. So what we're saying is, if I bought one property with Bryce and we paid $1 million for it, and the land value was $550, that's it. Both of us are now capped out.
Yep.
Okay. But if Bryce had bought one property, that same property by himself, he's got the full $550 for himself.
Yep.
And I've got the full $550 for myself.
Yes.
But because we combined the two together, we've both been caught in that capping out.
Absolutely.
Okay. So this is why it's so important to be a borderless investor. It's so important, and also making decisions on ownership can also be the case as well. So if you hadn't bought in joint names, effectively, and you bought in one person's name, then they've got their 550, and then the other person's got their 550. But because you bought in joint names, you're both caught in that 550 for that one asset.
Yep. That's it. Crash the contract, Ben. We're not buying that Potts Point mansion that we
property together.
Done. So okay. So to the second part of the question, Ben and I bought that property. We're up to 550 collectively. So then we go, all right. Well, we've got a self-managed super fund together. Why don't we go and buy another property in the self-managed super fund? That doesn't affect it in our own name.
No, it doesn't. No.
And then, so if it's any other entity, it doesn't matter.
Well, no, it doesn't. But no,
higher premiums.
So if you're using like a trust vehicle or something like that, the land tax rates are higher in the trust vehicles.
So they're going to get us.
And in some cases, there's no threshold at all. Is that right? In some cities and some types of properties, there's no thresholds. It's from $1 that you're paying land tax.
If it's held in an investment vehicle and not in your personal name, yeah, absolutely.
Yeah. So this is why it's so important to get the tax advice before you do what you do. Because there are some ways, and this is why we've always said, putting all your eggs in one basket in one city may not necessarily be the right way to go. Now, hey, if the property's going to double in value in every 7 years, good luck to you.
Yeah.
You know, you've got a 10 bagger, which means you've got an asset that's growing at 10% per annum. So keep doing it, because the small portion of land tax you're going to pay, you'd be happy to pay it. I mean, I'd cut a cheque every day of the week. But it does also then open you up to other markets to sort of say, well, if there's thresholds in every state, why don't I become a borderless investor? Why don't I look at those similar types of products that have had good success in the bigger cities and try and replicate that in the other capital cities around the country?
Absolutely.
Makes sense, doesn't it?
It's a key driver. And I mean, Queanbeyan, Ben, you wouldn't want to be buying in Queanbeyan and then decide, I'll just move over the border to Canberra or the ACT, and all of a sudden land tax kicks in straight away. So, that's a really good point. So thanks, Simon. It's part of your planning as you're building your portfolio. You should talk to your investment savvy tax accountant to help you with land tax.
And Bryce, just on that point, just for those people, I mean, obviously the Queanbeyan story is Queanbeyan's on New South Wales border of the greater area of the ACT, Canberra naturally. Because obviously Canberra, if you know the backstory, no one could decide whether Melbourne or Sydney was going to be the capital. So they decided, basically, Federation, that they'd build somewhere halfway, and that's what they did. And they designed this, sort of purpose-built city to be our capital. Now, that being said, the land tax, and we've talked about Canberra, in fact, on location score and through DSR, our demand supply measurements that we're doing, Canberra is coming up as one of the hottest capitals at the moment where there is strong demand and limited supply. So there's potential capital growth there. Now, as an investor, I'm very, very interested in that. But when we did the numbers in regards to the amount of land tax we would pay, because obviously it's not our principal home, we're going into those markets as investors, it crippled our return, absolutely crippled our return. So we've mentioned it before on the podcast that, be very, very careful about whether you're looking to buy into the Canberra market. If you're buying a unit in the Canberra market and you're chasing yield, well, obviously you're going to be sharing that 1/20th, 1/30th, 1/40th, depending on the number of units in the block. So your land component is going to be small. But if you're looking to buy a freestanding house in the Canberra market, please go and talk to your tax accountant and do some models. Go and talk to your property investment advisor and do some models around the cost, because it might be all well and good, you get great capital growth, but you'd be giving all your rent to the Canberrians in terms of giving them better pools and better roads and more bloody roundabouts. so from that point of view, just make sure you
remember when we landed there and we're talking to agent, what's the proportion of owner occupiers investors? I bet 95 owner occupiers. Okay, fair enough. Go to the next guy. 95 owner occupiers, and then we go, this is wonderful.
Wow.
And then we found out why.
We started getting is that the right land tax? Like, where, it's a 500,000. Is that? And we're like looking at that, and we went back to that, that night, and we started modelling the land tax back in the hotel room, going, this is problematic.
All right, we got one here. Last one, Ben, from James. Hi, Ben and Bryce. With the strategy of accumulating 3 to 5 good capital growth properties and potentially selling 1 to 2 in the long-term future upon retirement, would we not be best to, if possible, move into each property for minimum 12 months to avoid capital gains tax when the properties are sold? Thanks for such a valuable podcast. I always listen to each episode a couple of times a week. Thank you very much, James. Now, that's a good question there, Frank, because
absolutely,
you've got your capital gains tax exemption for your principal place of residence. But if we're accumulating properties, we don't necessarily want to sell them. But if we do,
Yep.
you've got a choice to make, haven't you?
Well, you do, yeah, absolutely. And again, it always comes down to a question of fact as to where you're actually living. If you're moving into a property for 12 months and then moving out and holding that property, then that property's gone from it is your principal place of residence for that 12 months. But then once you've moved out, if you've bought something else and moved into that, then generally that becomes your principal place of residence. So it won't alleviate the capital gains tax in its entirety. You'll be able to apportion it.
Mm-hmm.
But it doesn't completely alleviate. If you're moving in and then sell it after that, then at no point is it an investment property, then there's no capital gains tax. But if there is an element of income producing aspects there, then you're going to be subject to capital gains tax.
I think the best way to avoid capital gains tax, Ben, is very simple. Just don't sell. My first property mentor said, never, ever sell. And I've sort of, over time, hardly ever sell. Right. And that's been a mantra that, but yeah, if you're accumulating properties, you structure it the way that Ben and I sort of suggest our clients to do, where they retire out the debt. You can hold these properties, no need to sell them. Yep. Depending on how you've structured the portfolio, then you do avoid that capital gains tax. It becomes a legacy and you pass it on to the kids, which is a good question. So let's say I do pass on my portfolio to my kids, and then they sell it 20 years later. So Say the purchase was 10 years before I handed it over, and they sell it 20 years after they received it.
If the property purchase originally was pre-1985, then the cost base starts from when the property transfers into the child's name.
To the heirs, yep.
But if the property is purchased after 1985, then whatever cost base was, the original cost base from the parents, that just transfers to the children.
So that's a good point that you bring up there. Then 1985, I know the answer, but for the benefit of the listeners, why is that a significant date in terms of capital gains tax?
That was the capital gains tax regime was introduced. Essentially, so any properties purchased pre-1985 are not subject to capital gains tax, but after that, then.
So even investment properties, it's pretty cool, isn't it?
Yeah.
Which is partly why the depreciation of the building kicks in post-85 to help offset that, isn't it? Because you can't get depreciation of the building pre-1985.
Yeah, that's pretty much it.
Very good.
So just coming back to that other point, a lot of people still don't understand this 6-year rule in terms of when they're moving on. So I just quickly, we'll talk about what that means. So if you own a property and then you have to move for work purposes or whatever, and you still want that to remain your principal place of residence, you can rent that property out.
Yep.
You can obviously claim all of the standard costs associated with that property under the law. Then you move back into that property after 6 years for whatever reasons. The gain, so the value gain in that property is capital gains free because it's still your principal place of residence.
Absolutely.
Yeah. Then, however, let's say you don't move into that property, you still should get that property valued at that 6th year.
Yep.
Because effectively any capital growth you can measure and say that still might have been my principal home, but ultimately I've made a determination that with the job movements and everything else, I've now got another principal home, and so you can work, because you can only have one principal place of residence at any one time.
Yep, correct.
Yep. Okay.
Very good. All right, Ben, let's charge through some of those questions, which has been terrific. Mate, what was I know it's done and dusted for you, but leading up to the 30th of June, what was some of the top tips that you were giving to clients as to how they could frantically beat the 30th of June tax bill?
First thing was to actually talk to me before the 30th of June. On the 2nd of July.
Given we're after the 30th of June, that's ironic that I'm asking you this question.
Absolutely. Most of the time it's just more about tipping money into super and stuff like that as a way of reducing how much tax is being paid. And also just tax deferment, timing of...
Prepaying interest.
Stuff like that.
Do you get much of that with your clients?
Not really, because at the end of the day, it's a cash flow. Yeah, it is.
Yeah.
It is, but it's a deferment mechanism, so it can work quite well depending on what's happening.
Because once you start, you've got to keep doing it. If you want the full benefit of it, you've got to keep deferring it.
Yeah, but it comes back to people's personal circumstances and whether it actually is beneficial for them in what they're up to in the following year as well. So
there's obviously a big change through that financial year with the 9th of May at 7:30 Australian Eastern Standard Time. Have you got many clients that were caught off guard by that, where they were negotiating properties and then didn't finalise it until the days after that? And
I'm dealing with one at the moment actually who had a contract signed that evening of budget night, and they're still trying to work out whether the contract was signed pre-7:30, because the contract's not signed and sealed until all parties have signed. So they're still in deliberations as to whether they can actually factually prove that it was signed pre.
Right. And there has been a paper that's been issued by Treasury in regards to depreciation. So we've seen some initial. So now that is open for consultation. So rather than wasting, our energy on sort of telling you what the new depreciation rules are yet, we're going to wait until they've been sort of more formalised and passed through, and then we'll talk in more detail about that. But we would always still say to people around depreciation is that you should have still got a depreciation schedule done before 30 June, ideally, because ultimately you can go back 3 years.
Yeah.
So
2 years.
2 years. Sorry,
2 years.
My apologies. 2 years. It used to be 5, and they reduced it now down to 2. So
that works both ways. So you can amend your tax return 2 years, and the ATO can only amend 2 years as well. So they're on the same page.
So which means that if you did it before 30 June, you would have that extra year to go back.
Yeah.
So now if you're doing it in 1 July, you obviously only go back. So it was good. Brad mentioned that. Brad Beer from BMT Tax Depreciation mentioned that when we had him on recently. But let's get that depreciation stuff all sorted out once we know what it looks like.
And last one for you, I know someone. I was going to reveal who it was, but they bought a property. Actually, it doesn't affect them; it affects the seller. But they bought a property, a put call option,
right.
So that they had the right to. They entered into the contract, the option, prior to the 30th of June. Call it the middle of May, and then they entered into an option to sign a contract on the 3rd of July. So effectively what the seller was trying to do is move the capital gains tax into the next financial year. So it was done by a solicitor. The call option was totally legit. But my question is, would the ATO look under the bonnet of that and just go, I see what's going on here? The actual offer and acceptance was done on the day of the
pre-30 June.
Call. Yeah. What's your view on that?
I think the ATO could have a look at that. There's a section of the Act called Part 4A, which basically deals with anti-avoidance. This isn't avoiding tax, it's just deferring and timing, so more than likely they wouldn't have too much of an issue. Yeah. Depends on whether there's a massive disparity between tax rates for individuals at that point, and that's why they were deferring it. Whether it's just a timing thing, they're trying to just push it out.
And whether they could argue that they didn't know what the Treasurer or what was going to happen. Yeah. And that's a fair call, because we were blindsided in a lot of aspects in terms of some of the announcements and changes. So,
there you go, folks. We've been chatting with Frank Azzopardi, partner at YK Partners, and deals with a lot of our clients and a lot of their property investing queries. So, mate, we thank you for all of your wisdom.
You're welcome.
Coming on and helping some of those questions. What you probably noticed is there's actually more still there, mate. So we'll have to we'll have to get you back to cover those. But Ben, I'm going to do my life hack today.
Please, I can't wait.
Yes, I know you can't wait.
Should I do my 5 squats whilst I'm waiting?
Yeah. How they going? Did you do them this
Good.
morning?
Yep, absolutely.
Yesterday?
Yep.
Day before?
Yep.
Haven't missed a beat?
What's that?
Haven't missed a
Haven't
beat?
missed a beat.
All right.
Haven't missed a beat.
Okay. Well, how many days in a row?
4? No, 10.
My life hack today is, the title is Email Comes Later. You know I'm big on this, Ben.
Yes.
And I tell the team, I think there's an epidemic, Frank, that people drive their life via their email. It sets their agenda. They come in and determine what they're going to do during the day by what comes into their convenient box for other people's agendas, right? So if you start your day with email, it puts somebody else's priorities ahead of yours. So start your day, every day, with intention for what needs to be accomplished for that day, what you need to get done. Start your day with your priorities. Email comes later. And there's a mixed message here. Well, it's not a mixed message. There's a dual message here. One is for the listeners, but also I know that our team listens to this, Ben. So they know to come in, they set their priorities first, they drive their day, and then they check their emails later. So that's my life hack, Ben. If you're someone who lets...
It's a bit like when you text me and all that, I just get to it eventually, don't I? Or not at all.
The other day, Ben went on a little break. And then, in typical Ben, he backs to back as soon as he gets up, and he's doing this housing affordability talk, which was a big undertaking by him. So I'm the usual, people person. I send him a little note that night. Said, mate, how'd you go? Did you smash it? I'm sure you did really well. What do you think his response would have been?
Oh, you're lucky you got it from.
Yeah, well, I was going to.
I'm gonna see him like in the next couple of days. I'll tell him how it went then.
That is so Ben. So he comes back to me.
Busy.
He comes back to me. He goes, "All good, thanks."
All good here.
All good, thanks. I'm thinking, how insightful is that? Here I am thinking about him and his interpersonal sensitivity is just low on the radar.
Yeah.
All good, thanks.
All good.
I then found out that there was a bit more to it, Ben. But there you go. But folks, if you ever
Jane and the kids had a car accident, and so I'm sort of dealing with other sort of matters. I'm in Sydney, she's in a car accident in Melbourne, and like, everyone's fine. But it's like, so we've got a few things on. Bit of high priority.
With full respect to Jane and the kids, which I care about them a lot. Even if they hadn't had a car accident, I would have still got the same text message.
Probably would.
So I've learned my lesson, folks. If you ever get Ben Kingsley's phone number, don't send him a text.
No, you won't.
You'll
probably
get
a response.
donuts.
Yeah,
So,
if you're following me on Facebook, don't message me because I've warned everyone before. I don't even know what it
it was
is.
the funniest thing the other day too. He's over on holiday and then he sends, "Here's some photos for you, Mum."
Because that's the only way Mum keeps up to date with me. So she's a Facebook person.
You'll never see Ben posting on Facebook personal stuff. I was surprised to see him there with his hat on and everything. So there you go.
Here's some photos, Mum. There you go. I'm okay. Everyone's safe. We're all good.
Did you know?
Did you know a couple of big data facts? Ready? World's largest big data company, Google. Okay, processes over 40,000 search queries every second, and on average over 3.5 billion searches per day, or 1.2 trillion searches per year.
Who said there's no money in searches?
No, they said. Did you know also that a single Google query uses over 1,000 computers in 0.2 of 1 second to retrieve the answer? It's not bad, is it? 0.2 of 1 second. Bang, bang, bang.
That company might go places, that Google company.
And if anyone's interested in big data, basically the projections for this year is over $53 billion in value of understanding data analytics. So that market is growing substantially. Big data is the future.
We're using big data too, Ben, to pinpoint where to buy. We are well and truly on trend. So very good. And a little bit of housekeeping. If you're a first-time listener, our agenda is just to be the trusted source, Ben, for property finance and money management information. So we recommend, if you've stumbled across us in the last few episodes, and we haven't announced this for a little while, go back to episode 1. And here's the tip: go at 1.5 speed. Now the tip is for 2 reasons, Ivis. One is to get through the content quicker, because we're 126, divide that by half, there's probably 70 or 80 hours worth of information. But number 2, the second reason, is Ben and I had rubbish chemistry back then, didn't we?
Well, I was just about to say, look, we won't be offended if you do 2 times for our footy chat, our general introductory banter. Just get to the content.
Yeah.
I mean, all the other stuff, we're just embellishing ourselves. I mean, we don't know what we're
Back in
doing.
those early days, we were a bit stiff and formal. We both had personalities of Collingwood bloody supporters then, didn't we?
Oh, there it is. Let me pull my tooth out.
So yeah, that's the tip. Go back at 1.5 speed. And a couple of things. If you're I haven't asked this for a little while, Ben, but if you're a long-time listener, not if you've only just joined us, but if you're a long-time listener and you've got some value, it's really helpful for us if you go and rate us in iTunes. And ideally 5 stars, but it's up to you, Ben.
It's up to them.
It's up to them.
Whatever value
Ideally
they get.
5 stars, but we don't know how the algorithm works at iTunes, but we do know that if we're getting the ratings and we're getting the downloads, that helps us stay front of mind so more people can make better decisions when it comes to property. And of course, we've got an upcoming talk at the Sydney Property Expo later in October, Ben, that's coming up.
Yep.
And there's a bunch of realestate.com.au videos that are due to come out season 2. So if you're not part of our social media, Ben, you won't be able to check them out.
Oh, okay.
So go at the Property Couch, at Bryce Holdaway, and at Ben Kingsley AU. Check it out, and you can see it all there. So very good.
There it is. Another fantastic episode. Tax, one of my favourite topics. Not, but there we go. It's all part of the equation.
Right, the people are asking the questions. Ben.
All part of the equation.
But so it's been terrific again. Thanks for coming on, Frank. We will get you on the couch sometime in the future to finish the rest of those questions. But until next week, Ben.
Remember, knowledge is empowering, but only if you act on it. You tried to, I was going to forget it.
But there we go, folks. Until next week.
See you later.
See you later.